Welcome to the deep dive. Today, we're really plunging into a detailed stock report. It's for Ainos Inc., trading under AMD on Nasdaq.
That's right.
Our mission, really, to unpack this whole thing, understand what it's telling us about, financial health, valuation, momentum.
You find the key insights.
Exactly. Find those important, maybe surprising, and honestly, sometimes kind of puzzling bits for you, our listener.
Absolutely. And a report like this, it's not just numbers on a page, gives you a snapshot, but it's like assembling pieces of a puzzle, synthesizing all these data points.
Okay, so let's lay out those first few pieces. What exactly is Ainos Inc.? The report puts them in healthcare, medical equipment suppliers, medical specialties sector.
Right.
Their core business sounds pretty interesting, developing biologics for human and animal diseases.
Yeah, specifically, they're focusing on things like influenza, hepatitis C, thrombocytopenia, using natural human interferon alpha. And it's in a proprietary low-dose oral form. And their pipeline, it's got a few things going on. Veldona pet supplements, Veldona human therapeutics, and also these telehealth-friendly point-of-care test POCTs, powered by their AI nose tech platform.
AI nose tech, okay. And market presence. The report mentions a market cap of $13.4 million. Average daily volume, about 190,000 shares.
Oh, yeah. Relatively small cap.
Yeah. And as of July 3rd, 2025, the stock price was $3.19, which showed a 19.5% gain just on that one day.
Wow, quite a pop.
Yeah.
So to get that quick overview, the report uses Trendline's DVM scoring. That's durability, valuation, momentum.
Yeah.
Scores go 0 to 100, bad, medium, good ranges. Gives you that immediate high-level feel.
Okay, let's hit durability first. Ainos Inc. is listed as not eligible. Now, usually high durability means consistent growth, good cash flow, stable revenue, low debt, all that good stuff. So not eligible, that's an immediate flag, isn't it?
It absolutely is. It tells you right off the bat they don't meet the minimum criteria for that assessment. It's like a missing piece right at the start.
Okay, missing piece number one. What about valuation then? The score here is 14 out of 100, categorized as expensive valuation.
Yeah.
Expensive? Does that mean the market's just way too optimistic here, or what's going on?
Well, a low score like 14 definitely says the stock is pricey. Whatever strengths it might have, they seem to be fully factored into the share price already. It's not a bargain bin find.
Clearly not.
And the report really hammers this home. It says for the whole past year, basically July 24 to July 25, its valuation score was 100% in the bad category.
Wow.
And compare it to peers. Ainos at 14 is the lowest. Like Intuitive Surgical is 22.2, Abbott Labs 43.5, Medtronic 44.2. It's way off from those guys.
Okay, so expensive, lowest among peers. Very clear signal there. Now, momentum. The score is 38 out of 100. Technically neutral.
Yeah, neutral. So the momentum score looks at whether a stock is bullish or bearish based on technicals, price, volume, sentiment, that kind of thing. Neutral means it's not strongly one way or the other.
And again, lowest among peers.
Again, lowest. Behind Thermo Fisher at 37.6, for example.
Okay, but here's where it gets really interesting for you listening. Despite this neutral score, the report shows a one-year return of 293.8%.
Yeah, that jumps out.
Almost 300%. That's a massive gain. It just feels like a total disconnect from that neutral technical score. How do we square that?
It's a fascinating paradox, absolutely. It forces us to dig into the technical details. And what you find is Ainos is trading above all 8 of its simple moving averages and all 8 exponential moving averages.
Oh, okay. That sounds bullish.
Generally, yes. Very bullish indicators. Strong buying interest usually pushes price above those averages. It's also above 6 out of 9 oscillators in the bullish zone, things like RSI, stochastic oscillator.
I sense a but.
There is a but, pretty significant one. The day AMA-CD, that's the moving average convergence, divergence, it's below its signal and center line. And that's usually seen as a strong bearish indicator. So you've got this really mixed picture. Price action looks strong, above averages, some oscillators bullish, but the MACD is flashing a warning sign. And the day RSI is 42, kind of in the middle, neither overbought nor oversold.
And the price itself, $3.19, is way above its R3 resistance level, which is only $0.54.
Yeah, smashed through previous resistance levels.
So, okay, the puzzle so far, not eligible for durability, expensive valuation, neutral momentum, but this absolutely staggering one-year return, it just doesn't quite add up yet.
Exactly. Those scores are the headlines, right? To understand the why, we need to get into the nitty-gritty. Flip open the report to the actual financials. What are the numbers really saying?
Okay, let's do that. Unpack the numbers. Key ratios.
Yeah.
Yeah, paints a pretty stark picture, like you said. Negative PE, TTM, minus zero point 0.9.
Right. Price to earnings, negative.
Negative ROE annual return on equity, minus 74.4%. Negative ROA annual return on assets, minus 49.0%.
Woof.
For you listening, that basically means the company is losing money. It's not generating returns on shareholder equity or its assets. It's actually, well, going backwards.
And the report notes ROE and ROA are falling faster than historical averages, too.
Ouch. There's a PEG TTM of 0.5, which is less than 1. Sometimes people see that as good.
Sometimes, yeah, it can suggest growth potential relative to the PE, but you have to look at the context. And here, when you look at revenue and profit trends,
Well, go on.
total revenue annual is listed as 0.0, low in industry, and a huge negative revenue growth year over year, minus 83.0%.
43% shrinkage.
Yeah. And net profit annual is negative, minus 14.9 million. Net profit TTM growth is also negative, minus 1.9%. There's an EPS quarter year-over-year growth number that's positive, 63.2%, but even that is below the industry median.
So the core business, it just looks like it's shrinking and unprofitable. How does that possibly line up with a 293% stock return? Feels like two different stories.
It's a fundamental contradiction, absolutely. The numbers show the underlying business is struggling. Now, there are a couple of, let's say, relative positives noted. Long-term debt to equity is 0.6, below the industry median. And book value per share annual is 3.1, also below the industry median.
But these feel like, small details against that bigger backdrop of financial decline.
Right. And the balance sheet insights, this is as of December 24. The trends look pretty concerning, too. Total assets annual, down 9.5% year over year, falling faster than average. Total shareholders funds annual, down 36.5% year over year, again, falling faster. Working capital annual, down 66.3% year over year, also falling faster.
It's a picture of contraction. Assets shrinking.
Exactly.
Yeah.
And contrast that with total liabilities. They show significant growth, 79.9% year-over-year growth in liabilities, higher than historical averages.
So assets down, liabilities up. Not usually the equation you want to see. And this ties into the cash flow dynamics also as of December 24. Let's break that down.
Okay.
Cash from operating activity annual, negative 5.8 million. It is falling slower than historical averages, which is maybe a tiny sliver or something, but still negative.
Still burning cash from operations. Right. Cash from investing activity annual is also negative, minus 0.1 million, and falling faster. But here's the kicker. Cash from financing annual activity is positive, a positive 8 million, and it grew 63% year over year.
Ah, so they're raising money.
That's what it points to, likely from issuing debt or, more likely given the context, equity, selling shares.
So if cash isn't coming from the actual business operations or investments, it's coming from outside capital. For you listening, that implies the company isn't self-funding, right? It's relying on investors putting more money in. Is that sustainable?
That's the critical question. And it's rarely sustainable long-term if the core business doesn't turn around. The net increase in cash for the year is positive, 2.1 million. A huge percentage growth, 1,541% year over year. But like you said, driven almost entirely by that financing activity, burning operational cash, raising financing cash. That's the loop.
Okay, let's look at the trendline checklist. It gives that overall snapshot. And Ainos only passed 50% of the criteria, half.
Right down the middle.
Digging into the financial section of that checklist, only 2 out of 8 criteria met. It just repeats what we've seen. No consistent profit or sales growth, no high durability, no high Piotrowski score.
What's that 9-point check for financial strength?
Right. No strong ROE, no positive cash flow from operations for the last 2 years. The only 2 positives checked off, low debt and that positive net cash flow, which we know is driven by financing.
Okay, now shift to value and momentum on the checklist. Here, they actually met 5 out of 8 criteria.
How interesting.
It reinforces the expensive valuation not in historical PE or PBV buy zones. Valuation score doesn't signal affordability. However, it confirms the momentum score shows bullishness.
Okay.
The stock is trading above all those short and long-term SMAs we mentioned. It has bullish or no bearish candlesticks recently, and active positive breakouts.
So this is that paradox again, right? Expensive valuation, weak fundamentals, but technically some strong momentum signals are being flagged here on the checklist. How does that even happen?
It often points to a disconnect. Maybe market sentiment, short-term trading, speculation overriding the fundamentals, at least for a time. It's a real tension in the data.
Definitely. Okay, what about ownership on the checklist? Only 1 out of 4 criteria met.
Yeah, this is telling. Lack of institutional buying last quarter, no rising institutional holdings over the year, And crucially, insiders have sold stock in the past 3 months.
We'll come back to those insider sales. What's the one positive?
Promoters are buying or ownership is stable. That's the one check mark.
Okay. And peer comparison. 2 out of 3 met. Giving better long-term returns than the industry? Well, that 293% return would do it.
Right. And sales growth, surprisingly, better than the industry median, despite being negative overall, but profit growth, not better than the industry.
Got it. Okay, let's drill down on who actually owns Ainos Inc. You mentioned low institutional holdings.
Yeah, this part of the report is quite striking. The shareholding summary for June 2025. 99.8% of the shares are held by others' data.
99.8%.
Basically, retail investors, individuals like you potentially listening. Mutual fund holding, 0.2%. Institutional investors, 0.1%. Tiny. And those small percentages haven't really changed.
So it's overwhelmingly owned by retail. That's unusual for a Nasdaq-used stock, isn't it?
It's certainly on the very high end for retail concentration, and that can contribute to volatility sometimes. Now, let's talk insider trading, because this is really fascinating here.
Okay, lay it out.
The report shows recent sales, June 2025. Director Chung Jung Tsai and Director Ting Chuan Lee sold shares. Prices were between $1.50 and 55 cents per share.
50 cents. Okay, keep that number in mind.
Exactly. Now, contrast that with what happened back on April 8, 2025. Significant acquisitions. Chum Shai again and Chun Sien Tsai, who's the CEO and chairman.
Okay.
They each received 900,000 shares. Through grants or awards as part of their compensation, it seems. Some shares acquired at 48 cents per share. Some acquired at $0 per share.
$0 per share.
$0 per share. Grants.
Okay, so let's piece this together for you, the listener. Insiders got huge blocks of shares, almost 2 million between them back in April. Some cost them basically nothing, some cost 48 cents. Then just a couple of months later, in June, some insiders sold shares around 55 cents.
A relatively small number of shares compared to what they received, but still, they sold.
And now the stock is trading at $3.19. What does that tell you? Insiders got shares incredibly cheap, sold some near their acquisition price or slightly above the non-zero cost ones, while the stock price then rocketed much, much higher.
It definitely makes you wonder about their view on the valuation, doesn't it? Selling around 50 cents when the market now prices it over $3. It raises questions about their confidence in that current price level versus maybe just taking some minimal profit or covering costs on shares they got very cheaply.
It's certainly an interesting pattern. Okay, let's try and wrap this up, connect the dots.
So summarizing this whole complex picture for you, Ainos Inc. It's a real puzzle. You've got this incredible one-year stock return, 293.8%. That's a massive momentum. Some bullish technicals back that up, like trading above moving averages.
But
that stands in stark contrast to the fundamentals.
right.
Negative revenues, negative profits, shrinking assets, an expensive valuation score, almost zero institutional ownership.
And those insider sales near the bottom, relatively speaking.
Exactly. It all paints a very conflicting picture.
So this deep dive, hopefully, has given you a really comprehensive look at the raw data for Ainos Inc. It shows you this company with, yes, huge recent stock gains and some positive technical signs, but also really deep underlying financial problems and, frankly, concerning valuation metrics.
It's a company that just defies easy labels. High momentum play. Financially troubled entity. It seems to be both at the same time, which is unusual.
It really is. So here's a final thought for you to mull over. Given that dramatic one-year price surge, despite the weak fundamentals we've discussed, despite the insider selling, what else could be driving this? What factors beyond the traditional financial metrics that we've looked at today might be fueling investor interest, especially retail investor interest, in Ainos Inc.? That's something to perhaps dig into further on your own.